And for more, we're joined by Anthony Raza, Head of Multi-Asset Strategy, UOB Asset Management. Anthony, let's look at the labor market readings. So it was a mixed picture there with the ADP payrolls data coming in weak, but the weekly jobless claims, that one fell to its lowest level. I mean, investors, they continue to price in a rate cut next week. How much does this matter for risk sentiment? And what is your baseline policy, baseline for the Fed's policy path into early next year?
Yeah, so we would agree that there's been a number of labor market signs that have looked quite weak. That ADP series, we've actually had 4 out of the last 6 months be negative numbers. And so I think there's enough weakness there that it really sort of justifies that the Fed could be a little bit more concerned about the labor conditions than inflation, and therefore they likely are positioned to do another interest rate cut in December. And then I think even more importantly, I think markets are expecting that. And I think the debate now is really just how much more to come in 2026. It's our view to expect even a couple more rate cuts in 26. I think the market's pricing in a little bit more. But either way, I think, the U.S. market's sort of shifting from an area where they've had a lot of headwinds in policy from all the tariffs. And I think as we enter 2026, the rate cuts are going to help and some tax cuts are going to help. And I think it's a nice switch for the U.S. economy.
Yeah. So this mixed signals that we're seeing in the labor market, with jobless claims at 3-year low, the number of layoffs are high, as reported by Challenger Green Christmas in their recent report. It said that job cuts have actually now topped 1 million this year. I mean, how are you interpreting these cross currents, and what would they mean for corporate margins and even wage pressures?
Yeah, so there is conflicting data. I think a lot of economists have sort of boiled down to the fact that job increases have really stalled, but we haven't really seen significant layoffs. As you mentioned in that claims data, the latest number is actually fairly good. It's quite reassuring. And so I think a lot of economists sort of size this up as, a no hire, no fire economy, which, is maybe okay because that means you can continue with consumption. People have their jobs, will continue to spend. But I'd say the risk there is that usually that is the pattern you would see. First, companies, as they struggle, they'll start to reduce the pace of their hiring. And then if things continue to get more tricky, then they'll start laying off. So this may be just the gradual pattern. But at the same time, corporates are doing well. Corporate profits are good. And they're going to start to see, tax cuts benefits that should boost the economy in 2026.
Right. I think, meantime, the delayed PCE report is expected to show inflation holding just slightly below 3%. I mean, is this sort of figure good enough, you think, for risk assets, or could it limit the Fed's willingness to perhaps ease more aggressively?
Yeah, I think the inflation being above target remains a concern. But I'd say when you break down the underlying trends, I actually think the sort of core inflationary trends were actually in a pretty good pattern. And then you added in all these tariffs that kind of bumped up the number. And so I think the Fed's willing to take some risk that these tariffs are just temporary and that the underlying trend is actually okay. But it's a risky situation, and I think that puts the Fed in an uncomfortable position.
Right. At the same time, the 10-year Treasury yields, they moved back about 4%. How attractive are government bonds right now to you?
So I think government bonds, we get reasonable yields, but I'm not really counting on the interest rate cuts to really drive down yields. I think the fact is, U.S. debts are quite high. And I actually expect these yields to kind of remain around the same level. But for bond investors, I think that means you get a decent yield. And I don't think there's a lot of risk of bond yields going up when you're getting interest rate cuts.
Right. And right now, we're seeing S&P 500 reclaiming several key technical levels. From a multi-asset perspective, I mean, is this bullish momentum sustainable? And I'm also seeing several strategists kind of cite the possibility of a Santa rally, particularly if the Fed cuts. And so do you see this recent consolidation, past couple of weeks as a possible setup for this?
Yeah, so we kind of like the way asset classes look. So actually, bonds are doing well, gold's doing well, equities are doing well. And we don't really see any near-term catalysts that are going to disrupt this. Obviously, we're concerned about some of the valuations we're seeing in equities, but the fact is those patterns could last a while before you have a catalyst that really disrupts it. As we stand now, we're looking forward to 2026 earnings growth. And in the US, our forecast is for around 13% earnings growth. For Asia, it's around 15%. We have double digit in Europe and Japan as well. And so when you're getting that type of earnings growth, we kind of think the markets are likely to be able to chug along in a positive way like they did in 25.
Right. And the U.S. tech sector, as we've seen, it's been the primary market driver, but it's recently underperformed some. Could its leadership broaden more meaningfully next year, you think?
Yeah, and I think that would be an important trend to see. Obviously, if we get sort of more support in the economy from tax cuts and rate cuts, I'd say it'd be logical that you should get a broadening of the economy. The market has been overly dependent on those large tech companies driving the market, and it would be a very healthy sign if we can get more participation from more companies. We remain invested in tech, but there's a lot of things we're watching and anxious about, and we do recommend diversifying into more sectors in the coming year.
All right. Appreciate your time today. Anthony Raza, the head of multi-asset strategy, UOB Asset Management.